Good evening. I'm Frank Congilose. I'm the managing partner here at CNA Financial Group. It's always a pleasure to be with you. Happy holidays. We got holidays coming up in a couple of weeks. It's my pleasure today to have a guest with us, Ajay Kumar of SAI CPA Services. And I had the pleasure of visiting with AJ a few months back that we were chatting, and he was sharing me all of the different services and backgrounds that his organization does, how he creates value for people. And what I was so impressed with is how his organization was set up almost on a teaching environment where they're doing seminars, they're doing webinars, he's got a TV show, and all the different things that he was doing that I said, AJ, you're probably the perfect person to come onto our show to do some,
Thank
you
you.
know, planning around, year end, what should people be doing? So with that in mind, we put together a program on year end tax strategies on what you might consider doing, things you should be aware of. So with that being said, I'm going to turn it over to AJ. And AJ, it's so nice to be with you and to spend time with you again. And I'm going to hand it over to you because you're the expert on this topic. I'll ask you questions from here, time to
Absolutely.
time if I
Absolutely.
think that it's relevant, and we'll go from there. So it's
Thank
all
you.
yours.
Yep. Thank you, Frank. Thank you for the kind introduction. I appreciate it. And I appreciate the opportunity. I like being here. This is what I do. I have a similar presentation again this evening that we are doing for a lot of other clients. So I'm happy to be here. There are 15 tax strategies that we'll be covering in this quick time. If you need more information, please get in touch with Frank, get in touch with Elena, and we'll be happy to help.
Very good. So we'll let you take it from here.
Absolutely. So let me briefly tell you about myself first, so you know who you are dealing with. Why should you listen to me?
Hmm.
I have been around for 23 years in this field. I have 4 years degree in computer, MBA in finance from NYU, a CPA degree, business valuation degree, wealth planning licenses 3766. I'm not going to bore you about the MCSC, CNE, life and health, PNC, all the other nonsense licenses that I have. But nonetheless, so I have been around, I have experience. We have probably over 2,000 clients that we do business taxes, uh, all sorts of field. We have multiple locations, 3 locations, and we have about 84, 85 employees in the shop. Several of them, many of them are CPA, CA, CVA, CMA. Many of them are CPA wannabe, passed exam, 2 exam, 3 exam, and
Yep.
they're still working on it. So in this presentation, we'll try to cover some strategies that are useful before the year end. See, Frank, the thing is, everybody comes to us during the tax filing time and asks us one question, everybody. And after some time, you get immune to this question. What can I do to save taxes? And in many cases, we end up telling them it's too late for the last year. You should have done something before the year end. So this type of presentation is meant for those people with those strategies as what can you do now before the year end to make a difference to your tax liability. But again, we at size CPA services help people doing the business startup, bookkeeping, payroll, sales tax, annual tax. We typically don't do the wealth planning in-house, Frank. We will go with Elena, people,
So
experts like
that's why
you.
we get along so well, which is
Absolutely,
we
absolutely.
don't walk in your space, and that's why we don't give
That's the
any
right thing to
advice
do.
around taxes or law.
That's the right thing to do. See,
But
as
that's
much as
your
we know,
area.
we do a lot of webinars, seminars. We have Tax Tuesday. We have review trainings on every Thursday. We understand that unless you're doing it every day, unless you do thousands of cases, you can't be an expert in this thing. That's why when we need a wealth planner, we'll call somebody. Even though I have the licenses, I have never written a single policy. I have never written a single plan, Frank. So from that perspective, we use professionals when it comes to the wealth planning part of it. But let's go back to the tax strategies. So what does a tax strategy means when it comes to your small business? So take a step back. When you talk about income tax is a function of income. Higher the income, higher the taxes. It gets worse. Higher the income tax bracket, meaning the system IRS has 7 different type of tax bracket. It varies from 10% to 37%. More income you make, not only you pay more taxes because you have more income, you are pushed into a higher income tax bracket. So at the end of the day, it becomes a situation, how do I make more money but show less taxable income.
Right.
And that's where the deduction comes in the picture. What kind of deductions are there? What kind of tax different investment options are there where I can make higher income, gross income, and can push down my taxable income? That's what we call a tax strategy. So for a small business, there are different tax strategies for individuals versus small businesses. For a small businesses, a lot of small businesses, mom and pop shop, they don't understand where they stand. They're just going by
Yep.
the run. They just are trying very hard, making the ends meet, and at the end of the year, they'll find, oh, you made $100,000. Okay, now you owe $30,000. If they can figure that out in December, before the year end, and how much expected net income is going to be, they can make certain changes to their situation to make a difference to their tax liability. So for a small business, it's very important for them to take the quick look on their total financials, or have somebody do the bookkeeping, or have somebody reconcile the bank statement somehow. It's not rocket science. You can do it yourself, and then try to figure out how much income you had in the prior year. Another thing you want to know as a small business, IRS does not understand your business. We don't really know how your business runs, but we do know how much you reported last year, in the year prior. We have a history on the numbers that you reported in so many years. So we are comparing you against you. So when you file your 2024 taxes, we'll try to compare your 2024 taxes with 2023 taxes, with 2022 taxes. And let's say for a small business, the gross revenue is increasing year over year, and you are showing lesser profit. That will create a red flag. That
Hmm.
will potentially have an audit triggered over there. So not only you want to see where you stand, you also want to compare this situation, this year's situation, with prior years, to see how much do you want to show. Let's say, for example, you are showing 100,000 of profit, a cash-based business. You can try to make some payments now. Your credit card payment is due on 15th January. Why don't you make the payment on 25th December? Credit card company is happy to take it. On a cash-based accounting, you can claim it as an expense. Your rent is due on 1st of each month. Why don't you pay January rent in December? On a cash-based accounting, you can push it as an expense. And you don't want to make those decisions in isolation, not just randomly. First, understand where you stand. Then you see how you have been reporting what you have been reporting, and then try to plan it out right. So let's talk about some tax strategies.
Very
So we
good.
have quickly, we'll try to cover 15 tax strategies in 25 minutes. So if you are
Mhm.
not spending enough time on a particular tax strategy, we are happy to help. Please let Elena know, let Frank know, and somebody will get back to you. So first tax strategy that we emphasize is maximize your deductions. What it means is, if your taxable income needs to be lower and your gross income needs to be higher. Now, what type of deductions you can claim? For a small business, we talked about travel expenses, meals and entertainment, flight ticket. You are supposed to fly in February, but can you pay for the ticket in December? Can you book the ticket in December? So be creative about it. First, understand where you stand, then you see where you want to be, find the difference, plan your expenses, find more deductions. More deductions means lesser income. Lesser income means lesser tax bracket and lesser income taxes. But you ask, well, you have been talking about a small business, AJ. What about an individual? What can an individual person do? I don't have a small business. Well, think about it. You have a standard deduction versus itemized deduction, and take a step back. What's included in the itemized deduction? You start with medical expenses. A lot of people will tell you, if your medical expenses are not in excess of 7.5% of your AGI, they're not deductible. But hold on, that's the federal limit. Have you thought about the state limit? For the state of New Jersey, the limit is 2%. The point we are making is, if you have medical expenses, put it in the system, put it in the software. Don't think about 7.5%. If you're not saving any money on the federal tax return, you may end up saving some money on the state income tax return.
It's almost better to ask and try it
Absolutely.
than to
Then
just
just
say
ignore.
or assume that it doesn't work.
100%.
It's a great
100%.
insight.
Absolutely. So if the same schedule, we call it Schedule A, or itemized deduction schedule. After the medical expenses, you will see a special sales tax. If you bought a vehicle, car, or anything major, the sales tax amount that you paid over there can be tax deductible. Property tax, the limit is 10,000, but 10,000 is 10,000. It's not pennies. Put it in. If you have mortgage interest, put it in. How about charitable contribution? A lot of people will tell you, I can't really contribute to charities because I don't get any tax benefit. I'm in standard deduction. I don't get any charitable contribution. Well, then lump it together. Let's say if you're supposed to contribute $3,000 to church every year. So instead of contributing 3,000 every December, for this year you contribute it in December. For the next year you contribute it sooner. So this year you have 6,000. Cover 2 years together, so you can inflate your itemized deduction. Again, the name of the game is, how do I inflate my deduction? How do I have more deductions so I can reduce my taxable income? Now, when you're talking about deduction, one thing that a lot of people don't understand is the difference between credit and deduction. There is tax deduction, there is tax credit. So tax credit is always better than tax deduction. We have invested first 10 minutes of this presentation onto tax deductions. But if there is something better than deduction, it's called credit. Take an example. Let's say if your income is $100 and you're in 20% taxes, well, the tax liability is $20, right? So if I say, do you want $10 of deduction or $5 of credit? Which one is better? And the answer is $5 of credit. Let's do the example. If you have $10 of deduction out of $100, now your taxable income is $90. What's your tax liability? $18. 20% of 90 is $18, right? So the way the tax credit works, if you are $20 of taxes, the tax credit reduces your tax liability dollar for dollar, not the income, but the tax liability. So if you have $5 of credit, you pay $15 in taxes as opposed to $18 in taxes if you have $10 of deduction. So focus in situations, and it's very important, if you have foreign income, you can claim the foreign income tax paid as deduction and credit. The choice is yours. A lot of people don't understand the difference. A lot of people don't understand clicking this box versus that box can save them hundreds of dollars, if not thousands of dollars, depending on your foreign income. So please understand the difference between the tax deduction and tax credit. There are certain credits that are refundable credit, and then there are certain credits that are non-refundable credit. Let's understand the definition first, and then we'll walk through the example. So a refundable credit means if you don't owe money to IRS, will refund you the money. That's refundable tax credit. Non-refundable means if you owe to IRS, you can use the credit to offset that much liability, but you will not be allowed the refund around it. Take an example. Let's say if you owe $500 to IRS, and now you have invested some money into insulating the home insulation, and you have a tax credit of $1,200, right? Can you get this money back? In a refundable credit, you get $700 back. In a non-refundable credit, you can reduce the liability to zero, but you don't get any money back. So make sure you understand the difference between refundable tax credit and non-refundable tax credit so you can plan your situation better. Now, one credit, and this is a question that I typically ask in my seminars, give me a credit that's refundable and non-refundable at the same time. So
We
that
like double dipping.
yeah, double
Like both.
and that's called child tax credit. But the point here we are trying to help you understand, help what deduction means. Get to a point you know where you stand. Understand your history, find out what deductions you need to push, then take it one step further, understand the difference between deduction and credit. Once you understand that credit is better than deduction, see where can you maximize your credits as opposed to deduction. Then take another step to understand what's refundable credit versus non-refundable credit. The lot of people invest money into their home. We call it energy efficient credit. And the energy efficient credit can be up to $3,200. I took an example. Let's say if you're investing solar windows or energy efficient windows or solar panels, there are a lot of credits that goes around it. Every year, the credit could be as much as 30% of your investment or $3,200, whichever is lower. But 3,200 is 3,200. $3,200 is not a chump change. If you can save $3,200 by doing what you are planning to do anyway, make sure you keep proper receipts around it. What everybody has heard about electric vehicle tax credit. Everybody knows. We get a lot of questions about EV tax credit. People understand 7,500. People understand the income limit has to be under 300,000. But a lot of people don't understand, Frank, that there are credits available for used vehicle. If you're buying a used electric vehicle, you can still get a credit and it's not a deduction. It's a tax credit. And you can get a tax credit up to $4,000. There are some income limits around it. For a used vehicle, the value of the used vehicle has to be under $25,000. The new vehicle has to be under $55,000. Absolutely.
I'll let you keep speaking.
Absolutely. So for the new vehicle, the value has to be under 55,000, or for SUV, new SUV, the limit is 80,000. And based on your income limit, the income limits are for a married filing joint tax return. You have to have your income to be under 300,000. For a head of household is 225. For a single filer, your income has to be 150,000 or below to qualify for EV tax credit. But the point that we are trying to convey here, everybody talks about EV tax credit. We want you to know that there are credits, not deduction. Credits lower your taxes dollar for dollar, and there are credits available for buying used electric vehicle as well, as long as the value of the electric vehicle is under $25,000. If you have a business, let's talk about depreciation. You are investing money into the business. You are buying machinery, you are buying furniture, you are investing into creating a new office. Depreciation is a main thing, is a big thing now. During the COVID time, just to encourage small businesses to invest into the economy, there was a bonus depreciation clause that was created. So for 2022, any money that somebody invested, the bonus depreciation was 100,000, and it was supposed to phase out over 5 years. So for 23, it became 80%. For 24, for this year, it's 60% bonus depreciation. So you buy something for $5,000, 60% of it, $3,000 can be claimed right away into your business as an expense. So you only paid 40% and you have the use of it for next 5 years. Also understand about buying car. We get this question all the time. Should I buy the car under the business name? Should I buy the car under my personal name? If you buy the car under the business name and the gross vehicle weight rating for this car, this vehicle is over 6,000 pounds, you get to claim the car almost immediately, 100% depreciation. Gross vehicle weight
That's
rating.
a big savings.
Extreme. It gets double dipping. Think about double dipping now, Frank. You bought a car for $80,000. You paid $8,000 of down payment. How much is the tax benefit you are getting? $80,000. So
That's a big difference.
Out of pocket expense is $8,000, and you have created a deduction for yourself for $80,000. You did not even pay this money yet, but you can claim it as an expense.
Even if it was financed,
exactly,
I didn't have to write the check for the whole thing, but I took a deduction
for the whole amount. Almost the whole amount. The key is the vehicle has to be owned by the business, not individually. And the gross vehicle weight rating must be over 6,000 pounds. And how do you find that? Just put it on Google. GVWR, gross vehicle weight rating, and the model number. And the Google will spit out, this is the curb weight, gross vehicle weight rating for this vehicle. But please understand, depreciation, there is no expense to it. It can lower your taxable income immediately by a large amount. Let's talk about tax loss harvesting. Right now, if one thing is going good, that's the stock market. The stock market is going over and above. People who had
we like that, by the way.
It is good. I appreciate it.
Makes my life much easier when it's going up.
Absolutely. I 100% agree with that. So when the market is going good, one thing you have to be considering is the capital gain tax rate. There are two types of capital gain in a nutshell. Short term, if it's under 1 year; long term, if it's over 1 year. The short term capital gain tax rates are regular income tax rate, which varies from 10% to 37%. The long-term capital gain tax rates varies from 0% to 20%. So if you can delay the selling of an asset, buying the stock, buying the asset does not create any tax gains. Selling creates, if you the difference between the selling date and the buying date, if you can manage that difference over 1 year, then your tax rate is almost half of what the regular income tax rate is. The maximum is 20%. And if your income is over at least 520,000, and I'm just rounding up the number, only then you hit 20%. For most people, it's 15% long-term capital gain tax rate. So if you have assets, if you have long-term capital gain, what you do before the year end, find out the stocks, find out the assets where you lost money. Try to sell those assets. So you can do the tax loss harvesting. You can offset your capital gains against the capital loss. But make sure you understand the wash sale rule. In wash sale rule, you cannot buy the same stock 30 days prior to the selling date or 30 days after to the selling date. So there's a 61-day window. It's the wash sale. So it's not something that and it doesn't have to be the same stock, similar stock. It's not that I sell Google today and tomorrow I buy Microsoft. They will see they're both technology companies and they will try to disallow the loss. So just be cognizant about it. If you're selling something in the stock, don't buy the similar stock for next 30 days to make sure that the losses are not disallowed. As much as, Frank, we talk about deductions, we talk about credits, we also want to talk about estimated taxes, especially for the business owners. If you have a W-2 salary, then taxes are withheld. Before we pay you, we are taking some money out of your salary and paying it to IRS, paying to the state, paying the whole wide world. So
So,
as much as we talk about the deductions, lowering the income, we talk about credits, lowering the tax liability, we talk about differing income. What we want to focus on is the estimated taxes. You know where you stand if you can look at your business. You know how much income you will end up showing. And after doing everything from a tax strategy perspective, I want to bring your attention to estimated taxes. If you owe more than $1,000 in estimated taxes, you must pay the estimated taxes. And the estimated taxes are supposed to be paid quarterly in 4 quarters: April 15th, June 15th, September 15th, and January 15th. So even if most of your income comes in the fourth quarter, you are still on the hook to pay estimated taxes quarterly. We just picked up a client. The client had large liability with the state of New Jersey, $80,000. The client was blaming CPA, their prior CPA. When I called the CPA, he said that the client never paid the estimated taxes. So the state of New Jersey actually denies your extension if you don't pay enough estimated taxes. So you need to pay enough estimated taxes. There are websites you can go to for the state of New Jersey, for IRS. The point we are trying to help you understand, as much as you want to focus on deductions, tax credit, electric vehicle credits, energy efficient credit, refundable credits, non-refundable credit. After doing all this planning, if you believe you will owe taxes, try to pay these taxes sooner than later, as soon as you can. Then there are a lot of tactics that we have for delaying income. For a small business owner, we talked about paying rent sooner. Or let's say if a client is paying you checks, you have a large check coming on December 20th. Hold on to that check. Don't deposit the check yet. So you can count it as income for the next year. Delay income, pull some of the expenses. So there are some basic techniques that you can use to manage your income as long as you understand where you stand. The first thing is you have to know how much you have made. Where do you stand? In order to do the planning, the first step is to understand how does it look now before I start postponing the income, before I start pulling the expenses. Let's understand where we have. If you are selling an asset, consider installment sale, where you are paid some money now, some money next month in January. So you don't have to pay tax on the whole thing. You're paying taxes on 2 years now. You're disbursing the total tax liability over 2 years. And remember, more income means more taxes and higher the tax bracket. So if you can defer some of the income to the next year, not only you can lower the income over here, you can probably lower your income tax bracket as well.
AJ, as I listen to you going through this, the thing that jumps out to me and so obvious is you should be speaking to your accountant and to your tax advisor through the course of the year
Absolutely,
and
very important.
especially before year end to
Absolutely,
make sure that you're doing all of the things that we're discussing right now with
100%.
regard to if the quarterly taxes, because not only do they charge penalties, but they charge interest.
Absolutely,
And all of the timing of deductions and everything else. So should I take it this year? Should I push it to next year?
very
Income
important.
this year, next year? It's
It's the
very
same thing.
insightful.
If you take a step back, Frank, people call
Mhm.
you the wealth planner when the market is not doing well. As we said earlier, when the market is doing good, everybody is happy. But these people should be calling the wealth planner every quarter, every so often, that I have this asset. Should I diversify? I'm selling my home. What can I do? My home is giving me 8% return. Maybe the market can give them 10%, 12% return. They're guaranteed investment that
Right.
they can do when it comes to the wealth planning. The key is it's your money. It's your responsibility to manage it well. You can only make money when you are managing this money, when you take it seriously, not just a passive thing. So let's talk about the small business. We have a couple of more slides. We'll try to finish it in the next 5 minutes, and then we'll be happy to take some questions. So when it comes to starting the business, there are five types of entities that this system allows. Right from the proprietorship, we have partnership, LLC, S Corp, and C Corp. So the way you see proprietorship to C Corp, when you move from proprietorship to partnership to LLC to S Corp to C Corp, your cost of doing business increases. Doing the same thing under a C corporation is far more expensive, far more cumbersome than doing it under the proprietorship. But when it comes to legal protection, proprietorship does not offer any legal protection. C corp is something where you can do anything and sort of walk away. I mean, in theory. So the legal protection increases when you move from proprietorship, partnership, LLC, S corp, and C corp. But the cost of doing business increases when you move. So in your type of business, you want to understand what type of structure makes sense. Work with the accountant to see, oh, this is what I have. Does it still make sense? And have this conversation every year. So take an example. Most of the companies that we have in this country, Frank, are either LLC or S corp. A lot of people don't understand that LLC pays 15% extra taxes that S corp does not. Self-employment taxes. So if you have a profitable LLC where you are making at least $30,000, it will make sense for you to convert this LLC into an S corporation. But S corporation comes with a lot of strings, meaning everybody in the S corp, all the owners in the S corp must be US taxpayer. You cannot have foreign ownership in the S corporation. You cannot have more than 100 owners in the S corporation. S corporation cannot be a subsidiary of an LLC or a C corp. So there are certain conditions around it. There are certain rules that you have to follow. But potentially an S corporation is most tax savvy structure. That's why you will see all these professional firms, attorneys, architects, accountants, they're all S corporation. So just see which structure you have. If this structure that you created few years ago, does it still make sense? Does it still fit in your situation? And if it's not, can it be changed to a different type of structure? In your business, you will pay a lot of money to a lot of contractors, subcontractors. So 1099 is a document that you're supposed to file with the IRS, with the state. They have changed the rules around 1099. Now they have 1099 miscellaneous, a separate document, and 1099 NEC, non-employee compensation. On this slide, we talk about who should be issued a 1099. Just remember, if you paid more than $600 throughout the year, not in one transaction, in total, throughout the year, the whole year, you should issue a 1099. The obligation remains the payer, you as a business. If you don't issue the 1099, your expense deductions can be denied. Like, you did not file the 1099. This person did not include it in their taxes. Your expenses are denied. W2 employees are employees who are working with you at certain intervals. You can't really say, this employee works with me only on Fridays. Can I put it on 1099? No. We are expecting this employee to be working at a certain interval. This employee is supposed to come to your office, your tools, you are training him, is working in your office. In those cases, it's a more of a W2 situation. And a lot of people, Frank, they try to avoid W2. Not only is
They're
administratively
trying to
hassle,
avoid the payroll tax.
exactly, exactly. That's the key there.
But it costs them in the long run.
In the long run, it's not a good thing. If state of New Jersey does a lot of labor audit, we participate in a lot of labor audits. We pick up more clients because they are getting audited, and then they come to the CPA as opposed to coming to the CPA in the first place. So a lot of these audits are mainly because somebody should have been on W-2 and the business was paying them on 1099. So please understand the rule, understand the differences. And again, if there is any question, please get back to us and we'll be happy to help. Now, estate taxes. And now remember, there's a new government now or upcoming government. So the estate tax
There may
limits,
be some relief.
I'm hoping so. So the estate tax limits that we know now are supposed to expire on December 31st, 2025. Now the estate tax limit is 13.6 million per person. You can do Form 706 filing, which we call portability filing. Let's say if one spouse happens to pass away, God forbid, then you can do 706 filing to port the unused limit to the surviving spouse to have 27.2 million of limit when it comes to estate taxes. So we used to have few years ago, prior to last Trump situation, having trust was a big thing. You have a will, you have a trust, because the estate limits used to be 500,000, 1 million. Since the last Trump time, these limits were increased substantially, 10 million. So unless you have substantial asset, unless you're expecting your assets to be crossing these thresholds, and my limit is 10, I typically don't advise people to go into the trust arena unless
There's,
their current assets are at least $10
I
million.
agree.
So I mean, trust is an overkill, and I'm just kidding about it. If you are a trust attorney, I don't mean to be going on the wrong side. A lot of trust attorneys will tell you the trust is needed, and simple trust can cost you anywhere from $3,000 to $10,000, the whole plan. But in my opinion, you don't need a trust unless your assets are at least $10 million. I mean, the limits are currently $27.2 million. If anything, with the new government, we are expecting these limits to increase or at least stay the same.
We're hopeful.
We are hopeful not to go away. So please understand the estate taxes, the gift taxes. The gift limit currently per person is $18,000. And what I meant by per person to per person, let's say husband, wife giving gifts to another husband, wife, another couple, and they don't have to be related. Husband can give 18,000 to another person, 18,000 to his wife. Wife can give 18,000 to husband, and wife can give 18,000 to the other lady. Meaning, in total, this 18,000 becomes suddenly 72,000, and it doesn't have to be reported. Remember, gift is not tax deductible. It does not create taxable income for the recipient, and it's not tax deductible for the person who's giving the gift. So please understand the rules around gift. Foreign gifts are limited to 100,000, and they are related party to related party, not per person to per person. So there are certain rules around it. The question that we are typically asked, how much tax do I have to pay if I give $100,000 to somebody? And the answer is zero. The limit is $13.6 million. You have the obligation to file 709. For estate taxes, we file 706 form, like form 1040, like your personal taxes. So there's another form number around it. You file 709 form, but the tax liability is actually not there. It's a reporting requirement, unless you have gifted 13 million, and good for you. You have a lot of money. You don't need this presentation. So let's talk about the retirement contributions quickly. So there are a lot of retirement contributions that you can do that can qualify for tax deductions in your income. We have IRA. IRA are of two types, traditional IRA and Roth IRA. Traditional IRA gives you tax benefit now. Roth IRA doesn't give you tax benefit now, but the income grows tax free. So you don't pay the taxes when you take this money out. Again, please work with Frank, work with Elena, and they will be happy to guide you in the right direction when it comes to the IRA, 401k. They all have limits.
But on the IRA, we have until April 15th for them to
Absolutely.
deposit or make the
100%.
decision.
I
But
have
401k is going to be different.
100%. I did not want to bring this information now. I have a question related to this information after the end of this presentation. But again, the 401k limit is 23,000. And if you're over 50, you get extra
Catch
contribution,
up.
catch-up money. But 401k has to be, you cannot do your own 401k. You can do solo 401k, which is sort of a SEP plan, simplified employee pension plan, where the limits are much higher than typical 401k SEP. A lot of people miss this information. In a Schedule C, in a single member LLC. You can contribute 20% of your income or $66,000. Now it's 69. For the last it was 66, whichever is lower. So when we say the limit is, so if you are making $50,000, that does not mean you can contribute $50,000 to your SEP because the limit is $69,000. That's not how it works. The other factor is you can contribute only up to 20% of your income, meaning you can contribute $10,000. If it's an S corporation, and it's allowed for the flow through entity, S corporation, LLC, proprietorship, it's not allowed for C corporation. So for an S corporation, the limit is 25% of your W-2 payroll. If you are on the payroll and your payroll is $72,000, doesn't matter if the limit is 70,000, 69,000. You can only contribute $18,000 in this example. So just be aware of these limits. If you have a cash balance plan, or we call it defined benefit plan or defined contribution plan, they're only, in most cases, they will only make sense when you have no employees.
And you're older.
Or you are older.
Right.
So let's say the one exception that we have seen, this doctor who is almost 70-year-old, he had 3, 4 employees, some help staff, some nurse, whatever, and they were all like 20 years old, 25 years old. In that case, it made a lot of sense
Yes.
for him to go with the defined benefit plan. But in most cases, either defined contribution plan will make sense, not defined benefit plan, or you just scrap the cash balance plan. I mean, I have 80 employees. If I try to use cash balance plan, some of these employees are older than me, some of these employees are younger than me. I'll be paying more money for them.
You get a big deduction, but you don't get a big benefit.
I don't, yes, absolutely. So in many cases, it wouldn't make sense. So we have 401k limits here, we have SCP limits over here, and please make a note of it. Unless you have the income, you are not allowed to contribute to the SCP. And other thing I'll tell you about IRA requires earned income. A lot of people will on the Google, on these websites, you see, put your children on the payroll and you can save money because their income tax bracket is lower. They don't realize that I had a client, 2 years old child. He wanted to put him on the payroll. So he can
Doesn't sound
contribute.
like reasonable compensation.
Exactly. Exactly. So please, if you think you're not the smartest guy, there are a lot of people who came before you. There are a lot of people who came after you. So make sure you keep it sane, keep it consistent. We don't go in the gray area. Gray area. If you decide to go in the gray area, don't go in the black area. Just make sure you keep it sane. So now the question: which account you must contribute? Must is the key here before the year end. As Frank mentioned earlier, IRA, SEP, defined benefit, defined contribution, you can contribute up until April 15th, or if you file extension even later. So which plan you must contribute? Well, the answer is 401k.
Got to go
401k,
through payroll.
because it has to go through payroll. So 401k account must be contributed. Uh, so what's the minimum liability in the taxes that you have to incur the estimated taxes? And the answer is, we talked about it, $1,000. If you owe at least $1,000, you must pay the estimated taxes. Otherwise, you will have the penalty. Now, which of the following account grows tax-free? I have 401k, traditional IRA, taxable brokerage account, and the Roth IRA. Which one grows tax-free? We talked about it. It's going to be, yes, the Roth IRA grows tax-free. So please,
stressing out on these answers here.
So I thank you for the opportunity. Thank you, Frank, for inviting me, and I truly appreciate the opportunity. If there are any questions, please get in touch with Frank, get in touch with Elena, and we'll be happy to.
Very good. Ajay, thank you so much for being with us today, and for all of our viewers today and going forward. If you have questions, please put them in the chat box. We will follow up and get back to you. And again, thank you for being with us.
Pleasure.
For everyone who's watching this live and as we're doing this and so forth, I know we have the holidays coming up in a couple of weeks, so we wish you truly a happy and blessed holiday season and a happy, healthy, and a prosperous New Year's as we go forward. So thanks for being with us. Have a wonderful holiday season. We'll catch you on our next update. Thank you.
Thank you.